The Income Tax Act is over 1,800 pages long and nearly impossible to read. Believe me, I've tried. And the CRA has invested in over 55,000 employees with one job. Make sure you don't dodge any of the rules in there. I'm Sam Lichtman, financial planner and founder of Million Wealth Advisors, an independent financial planning firm in Canada. And today I'm going to show you 3 ways the CRA allows for you to reduce your tax bill, whether you're a T4 employee or a small business owner in Canada. And other countries typically have similar tax planning strategies available. We're going to start from the easiest to a moderately complex to a highly complex method that six-figure earners use to pay less tax. Okay, so let's start with method number 1, using the registered accounts the government has built for you. Now, this isn't going to be your typical explainer. We're going to go deeper into the strategies I actually use with clients to get the most out of each account, some of which I guarantee you haven't actually heard of before. So in Canada, there are 3 accounts that everyone needs to know about and needs to know how to use. The first one is the FHSA or First Home Savings Account, then the TFSA or Tax-Free Savings Account, and the RRSP or Registered Retirement Savings Plan. What you need to know at a high level is how this functions from a tax point of view and what you can do with the money when it's inside the accounts and how to withdraw it. These accounts look simple, but each one has hidden features almost no one talks about. So first, let's start with the First Home Savings Account or FHSA. This account gives you a tax deduction when you put money in, like an RRSP, lets it grow tax-free, and then lets you withdraw it tax-free to buy a home, like a TFSA. It's the only account that's tax-free at both ends, which is why it's the best government account out there. Yes, better than the TFSA. Now, most people who open an FHSA simply leave the money in their account and don't invest it, treating it like a savings account. But this could be a major loss depending on how long you leave the money in there. So let's look at what to do after you've created an FHSA and contributed up to $8,000 per year for a max of $40,000. So once you've opened your First Home Savings Account, you have a few options. You can leave your contributions sitting there and doing nothing. You can invest them, or if the account sits long enough unused, you can roll it into your RRSP. Leaving your funds sitting there though is the worst of the 3, but investing it comes with a caveat too. I'm personally a fan of low-cost index funds, but there's a problem with buying them inside your First Home Savings Account. If you invest in equity ETFs, something like VFV, which tracks the S&P 500, and you need that money for a home in the next 3 years, there's a real chance that you could lose some of it right when you need it. So here's a simple rule I follow with my own money and client money. Anything I need within 3 years gets 0% invested in stocks. Money needed in a 3 to 5 year window can be put in 40 to 60% stocks, and money needed in 5 to 10 years can be put in 70 to 80% stocks, and 10 years plus can be put in 100% stocks. But this isn't just my opinion. This time horizon approach is standard across the industry. It's what target date funds are built on, and it's supported by decades of return data, including the work from Jeremy Siegel and the Trinity study. Now, when I say stocks, I of course mean low-cost diversified index funds that invest in stocks like VEQT or XEQT, not individual stocks. So let's imagine you open an account in 2023 when it first came into existence, contributed $8,000 per year for the first 3 years. You were eligible. Now you have $25,700, assuming a 7% growth rate over 3 years, which even most balanced funds have delivered over the last 3 years. If you're earning over $200,000, say a year, every single contribution also gets you a tax refund of 48%. So you've contributed $24,000, already have had it grow by $1,700. Then you also get $11,520 in tax refunds. So by contributing $24,000, you now have a total of $36,000 available to you from growth and tax refunds. Then it comes time to withdraw, and this is where this second tax benefit comes in. You don't have to pay a dime of tax on the withdrawal as long as it's going towards buying a qualified home. It doesn't matter if the account doubled in value from your contributions. As long as you're making a qualifying withdrawal, meaning you're actually buying the home, then you pay no tax on the withdrawal. But that's not even the best way to use an FHSA, believe it or not. You can get even more gain from it if you do something called the FHSA rollover. This is a hidden tactic that many of my clients are planning to do to maximize their money. They max out their FHSA and never use it to buy a home. They invest aggressively for 15 years, then roll the money into the RSP tax deferred. They've effectively created excess RSP room because the rollover does not require RSP contribution room. They then use regular savings to pay for their down payment on their home. It's a way of creating extra RRSP room, and if you do the quick math, can have wealthy people sheltering an extra $350,000 over a 35-year time span if you get a decent rate of return. This strategy requires careful planning, so always get advice from qualified professionals. Now let's move on to the second account, the RRSP. This account is pretty simple in nature, but so often, even by high earners, it's not used correctly. So let's go over what an RRSP is, common mistakes people make using it, and how high earners use it to their advantage. The RRSP allows you to contribute up to 18% of your prior year's earned income to a max of $33,810 for 2026, minus any pension adjustments if you have a workplace pension. When you contribute, you get a tax deduction on the amount you put into the RSP, which is like it just subtracts off of your income. Then you can invest the funds and have it working for your retirement. Before we get to the more advanced ways to use an RSP, we need to go over the most common mistakes I see with RSPs. The mistake I see people make most often is that they actually forget to invest the money once it's in there. Maybe it's an old group RSP from a former job or an automatic contribution you set up at your bank when you turned 20 because that's what your parents told you to do, and you never checked on it, assuming your banker was investing it for you. Your banker of 10 years ago is probably doing something completely different with their life now. But I've seen people with over $100,000 in RSPs that have been sitting there for 10 plus years in high interest savings accounts because they thought someone had invested it for them. Don't make this mistake. For most people, investing in low cost diversified index funds or single ticket solutions are the simplest way to make sure that you are invested to meet your goals if you are a DIYer. And adjusting your ratio of stocks to bonds according to your time horizon and risk tolerance is really important. For example, if you're comfortable with risk and have a long time horizon until you need the money, investing in something like VEQT or VGRO may be an appropriate solution. If you are lower risk or need your money soon, you can switch to VBAL or VBAL or VCNS, a lower risk version of the same all-in-one, one decision ETF. Now let's get into more advanced ways to use your RSP. The biggest downside to the RSP is that when you go to take out money from it, it gets taxed. However, there are two ways to take money out tax-free that the government allows: buying your first home and going back to school. When you buy your first home, you can take up to $60,000 out of your RSP as long as it's been there for at least 3 months and you are a qualified first-time home buyer. If you're going back to school, on the other hand, in a qualified post-secondary program, you can take up to $20,000 out of your RSPs, $10,000 per year for 2 years, and then not pay any tax up front. But both of these programs do require you pay the money back into the RSP. When you want to withdraw funds that are not going to be for one of those two reasons, there is a tax you have to pay. However, unlike many misconceptions out there is no penalty to withdraw prior to retirement. Instead, there is a withholding tax to pay. And this withholding tax is just a prepayment of income tax. Think about it like you get a paycheck and you get your tax deducted. That's exactly what this is. If they take off too much, you'll get a refund. If you don't pay enough on the withholding taxes, then you'll owe at tax time. Now, you may be thinking like, why do high earners even use an RSP if it's taxed on the withdrawal? Well, think about it. You get a tax break going in and it's taxable coming out. The idea here is that you put funds into an RSP at a high tax bracket during your working years and then withdraw it in a low tax bracket, which is your retirement years. Because you had a larger amount contributed since it wasn't taxed going in, your final amount is much larger than if it was taxed going in. There are a few more niche strategies with RSPs that can be useful in some cases, like spousal RSPs. And spousal RSPs are where a high income earning spouse uses some of their contribution room to contribute to an RSP in the name of the lower earning spouse. This is done so that the income splitting can take place in retirement, specifically early retirement. However, now with pension income splitting eligible at age 65, the use case for these strategies have become limited, but there is a case where we recently helped someone effectively income split roughly $100,000 and allocate it to his wife, who paid next to no tax on this using the spousal RSP. And this may feel like a niche case, but it's why a lot of six-figure earners hire financial planners who are good at their jobs. At Mill & Wealth, we pour over these strategies for our clients and help guide them to implement these strategies that uniquely fit their needs. If you're a six-figure earner in Canada and want help with your investments or overall financial planning, click the link in the description to book a free intro call. And if we're not the right fit, we're going to tell you within 30 minutes. The final account to consider is the tax-free savings account. High earners use this to shelter hundreds of thousands of dollars over their lifetime, and most millennials, if they max it out and invest well, may have their accounts grow into $1 million by retirement. There's still a few common mistakes, as well as some lesser known ways to use the account. The TFSA works the opposite of the RSP. Any money contributed is taxed. However, whatever growth occurs while it's in the account is tax-free. Unlike the RSP, you don't need to make any T4 income to grow your contribution room. TFSA room is gained every year, regardless of income level. Now, what I see most Canadians mess up with in this account is very similar to what they mess up with on the RSP. They simply use it as a savings account and never invest it, or they think it's like a lottery machine and only invest in things they think will 10x or more, because who doesn't like a 10x tax-free moonshot? If you invest $40,000 and lose it all, here's the issue. You can't replace that $40,000 even in the next year. That room is gone forever, which is why you don't want to gamble with your money in a TFSA. And if you do want to have some play money to gamble with, do it in a non-registered account, because despite many people's tendencies to have an inflated view of their own investing ability, data shows you are much more likely to lose money when you gamble on a single stock. If you lose money in a non-registered account, you can claim a capital loss and then deduct it against capital gains. Mistakes aside though, how can you use this account to your advantage? The biggest thing you need to understand about the TFSA is the TFSA versus RSP debate. The reality is that high earners, at least the smart ones, use both. They understand the outcome after taxes is nearly identical in both the TFSA and RSP, and very rarely is one better than the other for high earners. The TFSA does act as a bit of a hedge against future tax policy changes though, because if you pay the tax up front to invest in a TFSA, meanwhile you pay the tax at withdrawal to invest in an RSP, it means that with the TFSA, you know the tax you are paying because you pay it upfront on your paycheck to then have the cash to invest in the first place. With the RSP, on the other hand, it gives you a tax refund, meaning your contributions are pre-tax and then taxes you at some unknown time in the future when you withdraw. And it's possible we have higher tax rates in the future, although historically in Canada, raising taxes on retirees has never gone over very well. So it's unlikely our current tax rates change significantly. Okay, so now we're done with kind of the more simple government accounts. We're gonna dive into something a bit more complex. Strategic household expense splitting. This strategy only applies to couples. However, even if you aren't married yet or common law, these are still important considerations for your future. How this works is that the lower earning spouse can invest their entire paycheck into non-registered accounts. Because the capital originates entirely from the lower earner, all future capital gains, dividends generated in that account are taxed at their much lower marginal tax rate. After the high earner has maxed out registered plans, then we have to get creative because the tax shelters are gone. So one way we can get creative is with strategic household income strategies and options like cash stamping. It starts with knowing your budget and fixed monthly costs. Now, on this point, I've had some people object. They're like, hey, Sam, come on, I earn 300,000 plus a year. Are you really telling me I need a budget? Yes, budgets are apathetic. They don't care about how much you make. They work regardless. Now, you don't need to cite every coffee purchase, but you do need to generally know what you're spending. This strategy only works if there's an income disparity between both spouses, but both of them works. So if I made, let's say, $300,000 a year as a T4 employee and was in a 53% marginal tax bracket with an effective tax rate of 38.34%, my wife makes $70,000 a year, there's a massive disparity in tax rates. She's at a 31.5% marginal tax rate and only 16.8% effective tax rate. She literally pays 22% less tax than me. Now say I had roughly $110,000 a year to invest between the two of us. Normally, people would assume about $90,000 of that would come from my income, $20,000 of that would come from my wife, given our income disparities. And that's also how typical households divide their expenses on a pro rata basis. But this is inefficient from a tax perspective because that means I am investing roughly $50,000 to $70,000 a year in non-registered assets that are taxable to me, and the other $40,000 to $50,000 in RSPs and TFSAs. All the non-registered investment returns are taxable at my high marginal tax rate. Wouldn't it be better if it was taxed at my wife's tax rate instead? Now, obviously the CRA is smart. They don't allow me to just give my wife money to invest in non-registered accounts. So instead of giving her money, I'm going to do the following. I max out my RSP. That's $33,800 for the year of 2026. Maybe I put half of that into a spousal RSP. Then I max out both tax-free savings accounts, both mine and my wife's, because the CRA does allow me to give my wife money to max out her TFSA with no attribution. So that's another $14,000 gone. So now what do I do with my extra $62,000? I spend it. And it's not what you think though. Instead of dividing up household expenses, what I'm going to do is I'm going to pay for everything: the mortgages, groceries, car payments, extracurricular activities, everything. Then my wife is going to invest 100% of her paycheck in a non-registered account. I know this sounds crazy to do this, but this strategy completely avoids me having to give my wife money to invest, which the CRA doesn't allow. At least they don't allow me to just give her money. I would have to lend her money. And it leaves a paper trail of evidence, which in an audit will show my wife's paycheck hitting her bank account, going directly into a non-registered investment portfolio in her name only. Now, there might be a few $1,000s left over in the budget to invest. That's okay though. The investment returns now are able to grow much more tax efficiently like this because they're taxed at a 22% lower tax rate than mine is. The paper trail does need to be clean though, and you need to go through a cash flow planning exercise first before you implement this to truly identify what your surplus actually is. And most firms ignore cash flow planning and just manage portfolio, but we actually literally just built a cash flow planning app for our clients to use specifically. And these insights are core to our clients and we specialize in this type of planning. Now, if you thought this strategy was cool, wait until you hear about this debt swap strategy that we recently used to move hundreds of thousands of dollars from a high earning spouse to a low earning spouse, saving them thousands of dollars in tax per year. The final strategy, and it's the most advanced, it's called the debt swap strategy. It's built for homeowners, though it's worth understanding even if buying a home is still ahead of you. This strategy is for people who have high incomes and can take on risk. This is not a maneuver for low income earners to make a quick buck. So that's important to know. Strategies like these should definitely be looked at by a financial planner and CPA before you employ them. That can be with us as we specialize in tax planning and investments, or with another firm with a trusted certified financial planner. Okay, disclaimer out of the way, let's dive into this strategy. If you haven't used the strategy we just talked about and you find yourself in a spot where all the non-registered money sits in your name or the higher income earner's name and very little sits in your spouse's or the lower income earner's name, don't panic. there are still a few options. And if you own a home or are thinking about upgrading, listen closely because this next part is gold. Okay, so let's meet a couple of fictional clients. We'll call them Felix and Marjorie. They're in their late 30s. They have 2 kids and they've done pretty well. Felix is the higher earner and has built up about $750,000 in a non-registered portfolio over the years, most of it in his name. Marjorie has very little in her own name aside from her tax-free savings account. Their current place is worth about $1.5 million and they've built up around $900,000 in equity. But with 2 kids growing fast, the house is starting to feel cramped and they've got their eye on a $2.2 million upgrade. Here's what Felix and Marjorie could do done properly and with professional guidance. First, they'd run a cash flow analysis to make sure they can actually afford the payments at an 80% loan to value ratio on the new place. Then Felix would liquidate his $750,000 portfolio to use as the down payment. Now, this is important. Selling that portfolio is a taxable event. So any accrued capital gains could get taxed on the way out and have to be factored in to make sure this strategy even makes sense. Now, doing this will cover more than 20% of the down payment on a $2.2 million property. When their old home sells, they roll the $900,000 of equity into the new house too. Now they own a $2.2 million home with a $550,000 mortgage. Here's where it gets interesting. They set up a line of credit against the new property, and Marjorie will borrow the money back in her name only. Now, most lenders will allow you to tap up to about 65% of the home equity through a home equity line of credit. On a $2.2 million property, that's roughly $1.4 million of available room. Subtract their $550,000 mortgage, and Marjorie now has about $880,000 that she can borrow. Remember that $750,000 portfolio that Felix cashed in to use as the down payment? Marjorie can now borrow that same $750,000 back from the home equity line of credit as a loan. And because she's using it to invest in a portfolio with a reasonable expectation of producing income, the interest also becomes tax deductible. And because it's structured as a genuine loan over the CRA's prescribed rate, it sidesteps the attribution rules that would normally kick investment income back to Felix. The result, Felix has effectively shifted a $750,000 portfolio from his name into Marjorie's. Going forward, the growth and income on that portfolio is taxed at her hands at her lower tax rate, not his. Now, this obviously carries real risk. There's investment risk, there's tax risk, and the mechanics have to be executed cleanly for the CRA to respect the structure. This isn't something to try on your own. You need financial planning and tax professional guidance, and both spouses need to be fully aligned for this strategy to work, but this is exactly the kind of planning we do for clients at Millen Wealth Advisors. These are just a handful of the ways 6-figure earners hold on to more of what they make. Just remember, nothing here should be taken as tax or financial advice, and your situation is unique to you. If you want to go deeper, you can book a call with me through the link below or sit down with an accountant who can tailor these strategies to you.